Can a revolutionary technology like Bitcoin truly be a viable investment? Today we'll dive deep into why Warren Buffett, the greatest investor of all time, believes Bitcoin can never be a good investment. Stick around as we explore Buffett's reasoning and uncover the critical insights that everyone needs to know about cryptocurrencies. So without any further delay, let's get started. The genius of blockchain versus the illusion of Bitcoin. Warren Buffett acknowledges the brilliance of blockchain technology, noting its potential for revolutionizing various industries. However, he distinguishes between the technology and Bitcoin itself, which he views as fundamentally flawed. According to Buffett, Bitcoin lacks intrinsic value because it doesn't produce anything tangible. Unlike a business or a farm that generates earnings or crops, Bitcoin's value is purely speculative. Investors buy it hoping to sell it at a higher price later, but it doesn't create value on its own. This reliance on market sentiment makes Bitcoin a high-risk investment. While blockchain technology is ingenious and has important applications, Bitcoin remains, in Buffett's view, a delusion and an illusion with no unique value. The Greater Fool Theory. Warren Buffett explains Bitcoin through the Greater Fool Theory, which describes buying non-productive assets with the hope that someone else will pay more for them later. This concept relies on a continuous cycle of buyers willing to pay higher prices. Bitcoin, lacking intrinsic value, fits this theory perfectly. Unlike productive assets that generate income or goods, Bitcoin's worth depends entirely on market sentiment. As long as new buyers keep entering the market, prices can rise. However, once the enthusiasm fades and the pool of buyers shrinks, prices plummet. Historical speculative bubbles, such as the tulip mania of the 17th century, illustrate how this cycle ends badly. Buffett believes Bitcoin is no different, making it a risky and speculative investment prone to collapse. The comparison with gold. Warren Buffett draws a poignant comparison between Bitcoin and gold to highlight Bitcoin's lack of intrinsic value. Gold, historically regarded as a store of value, possesses limited utility beyond its scarcity. Similarly, Bitcoin's value proposition relies on scarcity and market demand. However, unlike productive assets such as businesses or farms, both gold and Bitcoin do not generate income or provide tangible benefits. While gold has maintained its value over millennia, Bitcoin's value is highly volatile and dependent on market sentiment. Buffett's comparison underscores the speculative nature of Bitcoin and emphasizes the importance of investing in assets that have intrinsic value and the potential to generate income over time. Understanding this distinction is crucial for investors seeking to build a resilient and sustainable investment portfolio. Productive assets versus speculative instruments. Warren Buffett emphasizes the distinction between investing in productive assets and speculating on non-productive ones. Productive assets, like businesses or farms, generate income and have tangible value. Investors can evaluate their performance based on earnings, dividends, or crop yields. In contrast, speculative instruments, such as Bitcoin, lack intrinsic value and rely solely on market sentiment. Bitcoin doesn't produce anything tangible and doesn't generate income. Its value is driven by speculation and the hope that someone else will pay more for it in the future. While productive assets offer a basis for long-term investment decisions, speculative instruments like Bitcoin are inherently risky and subject to the whims of market sentiment. The role of market sentiment. Warren Buffett underscores the pivotal role of market sentiment in shaping the value of speculative assets like Bitcoin. Market sentiment, driven by emotions such as fear, greed, and optimism, can lead to dramatic price fluctuations. When investors perceive an opportunity for quick profits, they flock to assets like Bitcoin, driving prices higher. However, this sentiment-driven growth lacks a solid foundation in intrinsic value, making it inherently unsustainable. Buffett warns that when sentiment inevitably shifts, as it always does, prices can plummet just as rapidly, leading to significant losses for investors caught up in the frenzy. Understanding the influence of market sentiment is crucial for investors to make informed decisions and navigate the volatile landscape of speculative assets like cryptocurrencies effectively. The impact of institutional involvement. Warren Buffett weighs in on the involvement of large institutions like Goldman Sachs in the cryptocurrency market. While institutions may see potential profit in trading cryptocurrencies, Buffett doubts whether their top partners would personally invest heavily in Bitcoin. This skepticism reflects a recognition of Bitcoin's speculative nature, even among major financial players. Institutional involvement could affect the cryptocurrency market's dynamics, potentially increasing volatility and speculation. However, Buffett's skepticism suggests that institutional participation may not necessarily confer legitimacy or stability to cryptocurrencies. The impact of institutional involvement remains uncertain, but it underscores the importance of understanding market dynamics and investor behavior when considering investments in speculative assets like Bitcoin. The fundamental flaw of cryptocurrencies. Warren Buffett identifies the fundamental flaw of cryptocurrencies like Bitcoin: their lack of intrinsic value. Unlike traditional investments such as stocks or real estate, which generate earnings or provide tangible benefits, cryptocurrencies offer no such value proposition. Bitcoin's value is entirely speculative, driven by market sentiment rather than underlying fundamentals. This inherent flaw makes cryptocurrencies inherently risky investments, as their prices are subject to sudden and unpredictable swings. While some may argue for the disruptive potential of blockchain technology, Buffett maintains that the speculative nature of cryptocurrencies makes them unsuitable for long-term investment strategies. Understanding this fundamental flaw is crucial for investors to navigate the volatile landscape of cryptocurrency markets effectively. Historical precedents of speculative bubbles. Warren Buffett draws parallels between cryptocurrencies and historical speculative bubbles to highlight their inherent risks. Throughout history, speculative manias like the tulip mania in the 17th century, the South Sea bubble, and the dot-com bubble have led to dramatic price increases followed by catastrophic crashes. These bubbles were driven by human psychology and the fear of missing out, similar to the dynamics observed in the cryptocurrency market today. While some investors may profit in the short term, Buffett warns that speculative bubbles inevitably burst, resulting in significant financial losses. Understanding the lessons from past bubbles is essential for investors to recognize the signs of unsustainable market exuberance and avoid the pitfalls of speculative investing in cryptocurrencies. The broader economic impact. While the cryptocurrency market's total capitalization is relatively small compared to other asset classes, Warren Buffett acknowledges potential risks to individual investors and broader financial stability. If a cryptocurrency bubble were to burst, individual speculators heavily invested in cryptocurrencies could face substantial financial losses. Moreover, if large institutions become deeply involved in the crypto market and it crashes, there could be wider financial repercussions. However, Buffett suggests that for now, the primary risk lies with individual investors who have bet heavily on cryptocurrencies. Nonetheless, the potential for broader economic impact underscores the importance of prudent risk management and regulatory oversight in the cryptocurrency market to mitigate systemic risks and protect investors from the fallout of speculative bubbles. Warren Buffett's critique of Bitcoin centers on its lack of intrinsic value. Unlike productive assets, Bitcoin doesn't generate earnings or provide any tangible benefits. It's a purely speculative instrument, and speculation is always risky. While some may profit in the short term, the long-term outlook for Bitcoin is bleak. Buffett's insights serve as a cautionary tale for anyone considering investing in cryptocurrencies. Thank you for watching. If you found this video insightful, don't forget to like, share, and subscribe to our channel for more insightful content. Until next time, stay informed, stay cautious, and remember to invest wisely. Enjoy the rest of your day.